Welcome to the Time and Money Network, where smart business is done. I'm your host, Jason Couch, and this podcast series features business owners, entrepreneurs, business coaches. Every episode designed with a new guest who's going to open doors and open minds. They're going to reveal how they view time and money, how they leverage it, but more importantly, teach you the concepts that can change the way you think about time and money. Learn from the best minds that aren't teaching it, but doing it. Welcome to the Time and Money Network. Today, we are interviewing two of the greatest mortgage gentlemen in the history of this planet. We have Kyle Wilcox of Fairway Independent Mortgage and Brian Tutt. What's up, guys?
How you doing?
How's it going? That's the best introduction we've ever had, Brian.
I know.
That's
awesome.
what we do on the Time and Money Network.
I love it.
That's it. We save time. We help people make more money. But mortgages is such a interesting topic that I think a lot of people don't know the ins and outs of mortgages. So today we're going to talk about what is a mortgage, what's the industry all about, and more importantly, why you guys are better than every other lender that is pitching you mortgages. How's that sound?
Exciting. Very
Perfect.
excited.
All right. Well, let's get into some of the boring stuff. I think some people heard the word mortgage, but what is a mortgage?
Well, mortgage is a loan that a lender gives you to buy a home,
Got it.
right? Just like a car. If you go get a car, a lot of people don't have the money to pay cash, so they get financing. Same thing with a house.
That's right. And then most mortgages, they secure the house in exchange for the loan. So if you don't pay the mortgage, what happens to the house?
They take it back.
They take it back. Okay, so just like a car.
Yep.
All right, very good. So here's some confusion that even I in the industry don't really know. Where's the money come from?
The way I explain it is like a big credit card. A direct lender will have lines of warehouse lines to fund the mortgage. So we use that to pay the mortgage to get you to buy the house from the seller. And then afterwards, we need more money to fund, so we'll go sell that to an investor, Fannie, Freddie Mac. They'll refund our credit card, and we'll go do some more mortgages.
So Fannie and Freddie are brother and sisters,
They are.
and they were born from the government.
They were.
And the government's the parents of Fannie and Freddie.
That's exactly right.
And
Yep.
they act very similar. They get into mischief and things like that. Very similar, but they're all supported by daddy government.
They are.
Yep.
Okay, awesome. And you said warehouse line. I think a lot of listeners don't know what that means. Are we talking about a warehouse with an assembly line? What is a warehouse line?
No, it's like a big credit card. So
Big credit card.
it's a line of money that we can use to go fund homes, right? And financing on the homes.
Got it. So if I was going to launch a business, it's like some equity company giving me a bunch of money to pay for a bunch of employees that don't do much.
There you go.
Okay, very good. Very similar. It's
Yeah.
good for the Time and Money Network. I talk a lot about that. Okay, people will relate to that for sure. Now that we have the money and we've closed on the mortgage, who's servicing this? Where are people sending their payments to?
There's a bunch of different services that we use, but just think of it like this. It's not as important as where the money goes, it's what they do. And so the servicer is going to essentially call you to make the payments. That's where you'll make your payments. Your escrow, they handle the monies for the taxes and the insurance. We at Fairway use the three biggest ones. We use Flagstar Bank, Nation Star,
Mr. Cooper?
And Mr. Cooper, yes. And then
Mr. Cooper.
Correct. And then one of the big banks, U.S. Bank.
Got it. So these servicers, they take on the debt from somebody like a mortgage company. I think, what is it called? Table funding? Is that what people are doing?
Yep.
So table funding is the technical term for taking a warehouse line and funding a short-term funding to the title company, so the mortgage is set, and then they take that and sell it to one of those servicers.
That's
Correct.
right.
And
Okay.
that usually happens in about 15 days.
15 days.
Yep, absolutely.
So within 15 days, the mortgage company you did business with is pretty much out of the picture, and you're just sending payments to a servicer who is then backed by Fannie or Freddie Mac.
Mm-hmm.
So in case you don't pay, then we know what happens.
That's
Absolutely.
Okay.
Yep.
That's right.
All right. So let's talk about the different types of mortgage companies. Now, being in the industry, I know everybody's sort of saying these big banks, there's so many paper cuts and there's so many things you have to document. Actually, I know somebody right now where a loan has fallen apart because of an arbitrary piece of paper. Mm-hmm. So we got the big banks, and then we got mortgage brokers, which is what you guys are, correct?
Well, we're a direct lender. So
Direct lender.
Direct lender, yeah. And so we work directly with the consumer. There's no middleman. Just think of the broker as kind of a middleman in the relationship. And so The direct lender would deal with the consumer. In a broker relationship, you would deal with the broker. Then the broker would go to look at different lenders.
Got it. So you're almost cutting out the middleman.
Cutting out the middleman.
Which, you know, the more hands in the cookie jar, the worse it is. So we remove the hands from the cookie jar, so it's going directly to you.
Absolutely.
Directly to the servicer, and then insured by Fannie or Freddie.
Correct.
All right,
Absolutely.
there we go. I hope that made it somewhat simple for the listeners, because a lot of people don't know these definitions.
And I'll add to it a little bit. It does make a difference on who you're working with, because you mentioned the big bad banks. What do the banks want? They don't want to do mortgages. They want your deposits, right? They have a little office off to the side that, you know what, we'll do a service for our clients to keep the money with us so we can go make more money. And they'll do mortgages, right? Then you have, like Kyle said, the middleman. It's mostly important to deal with a direct lender. Go to the source, right? Don't worry about, we're the ones that actually review the file, underwrite the file, fund the file. You're not having to worry about if the bank is going to make you do extra paperwork and then take the house because they didn't check something properly.
Right.
Come straight to the source.
Right. And if any of our listeners want to go down a rabbit hole on the internet, Google fractional banking. And the way that this functions is banks can lend out a massive multiple of loans based on every dollar that they have on deposit. Very interesting thing if you want to go down a rabbit hole. But not today and not on this show. You keep listening to the end. All right, guys, mortgage lingo. I keep hearing this term DTI. What is that, the new latest rap artist?
Not exactly. Debt ratio is DTI, debt to income ratio. Basically, what we're measuring is how much of your monthly income goes to paying your debt.
Got it.
And we want to keep you under a certain threshold, because outside of just your mortgage and your credit cards, you have other living expenses, right? So especially now, gas, groceries, utilities, just extracurricular costs a lot more now.
So for the listeners, let's figure this out. If somebody can prove, that's a very important point, guys, you got to prove that you make $10,000 a month. And I believe the back-end ratio or debt-to-income ratio is about 43% right now?
That's right.
Yep.
Okay. So at the end of the day, after you pay all your expenses, all your child supports, all of your bills, you have to have $4,300 left over to pay a mortgage, and that would be a debt-to-income ratio.
That is right.
Correct.
Right. And if you're Elon Musk, you can buy whatever you want. You
Satellites,
can buy Twitter.
planets, whatever you want.
All right, I'll skip. All right, so let's go on. FHA. What is this term? Federal what?
Housing Administration, Federal Housing Administration.
Good,
Basically, they're
administration.
insured. Yep,
Not
absolutely.
Association Administration.
That's
Okay.
right.
And what do those guys do?
Basically, they insure the debt. They're not an investor, but they insure the fact that we're making good decisions. And so, if in your scenario where the loan went bad, they insure it so that the investor doesn't lose their money.
Got it. And to my understanding, if you're getting an FHA loan, the reason you could put such little money down is because there's a big bad insurance company called the federal government. And if that servicer, Mr. Cooper, doesn't get his money and he has to foreclose, I believe FHA will cover 20% of the debt that he services.
That is right.
That's absolutely right.
So that's why when you don't do FHA, the olden days, you used to always put 20% down because that lacked the government insurance. So this is an insurance that you guys are going to pay your bills, right?
Correct.
All right. So VA, I'm sure that's very similar. What's VA stand for?
Veterans Administration.
Okay.
So for all of our veterans out there, this is a program where the government will provide a guarantee, similar to FHA, but allows the veteran to get 0% down.
0%.
0% down.
How do they get away with that?
Well, just because they guarantee it. So just kind of like the Federal Housing Administration, they'll provide an extra coverage for the servicer to, if anything defaults, that they'll cover that debt.
Got it. And all our real estate professionals will understand this only if it appraises. All right. So conventional, what does that mean?
Conventional is basically just a standard loan that Freddie and Fannie offer. And so it's kind of the 80% cut and dry vanilla type financing.
Got it.
And that's offered by Fannie and Freddie.
So whenever you think of a normal mortgage where you put 20% down by Mr. Bank, who's servicing it by Mr. Cooper, that's usually a conventional loan.
Yep.
And that's the
right.
favorites for a lot of people who are transacting real estate because it seems to be the safest, most confident type of loan, right?
That's
Correct.
right.
Okay, awesome. So now I want to talk about Fairway. Why do you guys keep people in the fairway and out of the sand traps?
Well played.
I love
Thank
it,
you.
man.
Well
That is
played.
awesome.
Thank you.
So Fairway is not like any other company. We are one of the largest purchase lenders in the nation, non-bank. Been around for over 26 years. And one of our secret sauces is our CLO. We don't have a CEO. We have a chief loan officer.
Chief loan officer.
Chief loan officer, Steve Jacobson.
Got it.
So he is very big, and the reason why he got out of other lending companies is because he realized they were after the transaction and not the client.
Wait a minute. A salesperson was after their money. That's shocking.
Right.
So you fixed that.
We did.
Okay.
So he is extremely big about the clients.
Okay.
We do not miss closings, and it is to the point that if he sees a closing missed, he jumps in personally to call the client.
Got it. It's like the bat phone. You have a red phone on your desk. There's a problem. You pick it up. He solves it.
That's it.
Which is so super important in this industry because I've heard and experienced so many horror stories where a buyer and seller have moving trucks packed. Everybody's out of the house. They're ready to go, but then Mr. Underwriter comes in what's called a stipulation or STIP as a shortcut and says that, oh, we need a document from 1983 or we can't close. And then new regulations, correct me if I'm wrong, once anything changes, they have to wait 3 days for that document to season.
That is right.
So if you're not prepared for a closing with the right mortgage company, you can be in a lot of trouble with a lot of moving trucks and a lot of upset wives.
And happy wife, happy life,
Happy
right?
wife, happy life. Don't I know it?
Rule of life.
All right, so that's why you guys are different because you guys actually care. It's not always about the money, although you guys are very successful in what you do, but it's all about service and predictability and saving time, which is why you're on the Time and Money Network.
Absolutely. Just think nationwide strength, hometown service.
There
That's
you
what
go.
Fairway is.
I like that.
Yep,
We
yep,
like a little
absolutely.
hometown service.
Yep.
We need that now.
Absolutely.
Everything's corporate, press the button, things go. What happened to a phone call?
Right.
Who talks on the phone anymore, right?
Yeah.
You know, sometimes I have to tell, because I'm also in real estate, I have to tell some agents that there's never been a real estate transaction ever done without talking on the phone first. So if you get on the phone first, obviously that will accelerate your success. All
That's
right.
right.
So let's talk about something else. So we already know why you guys versus the other guys, but I want to talk about all these discount lenders because it's very, very tempting and seductive, for the lack of a better adjective, to see all of these internet companies where I can do it for 1.5% interest rate and this and this and that. What people don't realize, and correct me if I'm wrong, there's a bunch of fees associated with doing a loan. So someone can give you a fantastic interest rate, but pack a bunch of fees on there. So I want to talk about a term called APR, which is very important to see what your total cost is. Can you explain APR?
APR is basically where you take not only the rate, but all the fees associated to it and combine those to figure out what your true payment is and what you're really paying back over time.
Okay, great. So let's just keep things simple. We won't do math because math is not fun. If we have a $100,000 loan and you're at a 1% interest rate with zero fees, what's your APR?
1%.
Okay, and if you have $500 fees on that $100,000 loan, plus the 1%, what's your
1.5.
APR? There you go.
There you go.
So when you're looking at these discount lenders, always check with Fairway first because they want to do the challenge and show you what your true APR is. Not only could you get some of the best APRs, but also the best service with the hometown flair, right?
That's absolutely
Okay.
correct.
Very good. So let's talk about why the interest rate isn't the whole picture. Now, there's different types of loans. There's different down payment requirements. Most people are so sensitive on an interest rate. So 4.75 has to be better than 4.875. But what if you're on a 5-year term where there's a balloon at the end?
Right.
So let's talk about the whole picture. What are the components to a mortgage besides interest rate?
Well, it starts with what you're trying to get accomplished, right? We get a lot of clients now that with the rising prices and everything else that they might not have enough for down payment. So there's other things that we can look at. There's down payment assistance programs to help them get into the house. So if their main purpose is to get into a home with little money down, there's ways to do that. Now, that doesn't mean it's going to be the lowest interest rate, right? But we can always adjust your financing terms, right? We cannot give you back money you lost by waiting.
Yeah, and let's talk to the first-time home buyers out there because a lot of them are a little bit discouraged by the pricing in today's market and the interest rate rises that are going on. But what's the alternative? Do you want to stay a renter? Do you want to be paying somebody else's mortgage? Almost all wealth is derived from real estate inheritance. We won't talk about that, but real estate, stock speculation, and inheritance. So your first step to getting the right trajectory is to get a house and buy it right. Now, to buy it right, you have to get pre-approved. Now, being pre-approved is your battle plan. That is your weapon so that sellers will take you seriously. And if a seller takes you seriously, why not try to buy a foreclosure or a distressed home? When you go in and you look at real estate, all you want to look at is what will it trade at today versus what am I buying it for? Now, that segues me into debt. Why do people think debt is bad?
I think it's just an old school way of thinking. I mean, my grandfather grew up and said, don't have any debt, pay cash, right? I remember starting my own lawn business, and he said, okay, take 10% and put in your pocket and 90% in the bank, right?
That's smart.
And I was like, no, Papa, it's 90% in my pocket, 10% in the bank. You got it wrong.
Correct.
But they just feel that if you're under debt, then you're under somebody else's thumb, right? And that's just never been perceived as a good thing.
Right.
But I look at it like this. You have to have money to make money, right?
Right.
So where do you start? And so one of the good ways to start is you go get a loan for a mortgage with a very little down. And then that asset that you just bought is appreciating year over year after year. And then after 5 years, you can take the money that you've made off that asset, use that capital to go buy some more assets.
That's right.
And so it's a great way to do it.
And a little disclaimer, it's supposed to appreciate. We cannot speculate on future real estate values. We're not financial advisors, but
absolutely,
historically, home values appreciate statistically, correct?
Right.
Okay. And then first-time home buyers, did you guys know that you can be gifted funds? So if you don't have a down payment, people probably waiting years longer than they should when they can borrow money from Uncle Buck or
Absolutely.
something, right? Can you explain how gift money works?
Yeah, right now, one of our largest populations in the U.S. is 28 to 32. And kind of what we're talking about, they're wanting to rent because they don't feel like they have enough funds to put down. But you can have a family member, which a lot of family members are willing to do, help invest and give you that money to put down to get into a home.
That's right. And I believe the requirements are not that severe. You need a gift letter.
That's right.
I want to give you money, period. Sincerely, Mom. And then you need a it's called seasoned funds of some kind, or is that out the window?
No, you really just need a gift letter, and you need what they call source the funds. You just need to know where they're coming from.
Got it. So we have to figure out it's not coming from your friend. It has to be an immediate or just family member in general. What is it?
Family member in general.
Okay. So Uncle Buck wants to give you money. He says, I'll give you $50,000, sincerely, Uncle Buck. You submit that to the underwriter. They source it. Yes, it came from Uncle Buck's bank account. And now you're buying a $200,000 house with 25% down, right?
Absolutely.
Okay.
Hey, I'm going to blow your mind.
All right, blow my mind.
So it doesn't have to be a family member. There are programs in the state of Texas right now that do down payment assistance.
Got it.
And so essentially it's a grant, a forgivable grant that you can get a loan for, and then after 3 to 5 years, then it's forgiven.
That's right.
And so we had an example for a customer the other day that we wrote him a check for $1,700 at closing.
Holy cow.
So he not only didn't put money down, he got a check from us for $1,700 at the closing table.
Well, that's his groceries for at least 2 weeks, right?
That's phenomenal.
Wow.
Yeah. So there's all kinds of programs out there if you have the right lender that knows how to take advantage of them. And so down payment should not be an obstacle in many cases.
You see, guys, first-time home buyers, there's 32% of you or something out there. They're sitting in rent on the third floor, climbing 3 stairs, Bubba the truck driver is your next-door neighbor. You want to buy a house, go to these guys, have a consultation, see what they can do for you. You got gift funds, FHA, VA. Interest rates are higher now than they were, but do you care if it's $28 more a month? You're a homeowner, and you always can refinance out of any interest rate issue you ever have down the road, pending credit, of course, and qualification.
Right. Hey, you marry the home and you date the rate.
You date the rate.
You date the rate.
You marry the home and you date the rate.
Absolutely right.
Say that 5 times and you'll make a mistake really quick. Date the rate.
Date the rate.
Date the rate. All right. So I want to get on so debt. Let's give some examples of what good debt is. Because, paying cash for a primary residence, in my opinion, is one of the silliest things you can do in America. Here's why. The greatest gift America gives us, or one of the greatest gifts, is able to deduct the interest and property taxes on your primary residence.
That's right.
So if you got a mortgage for 5.5%, if you are at an effective tax rate of, say, 30%, well, you're almost like only paying 4% because you're getting tax deductions you would have never got before. Is that correct?
That is right.
Okay. So I'm going to use a really big word, and this is an investment term, so bear with me. It's called arbitrage. You can do debt arbitrage. And what is arbitrage. Do you guys know the definition? It's okay if you don't.
No, I don't.
No.
That is a really big
It's
word.
a big word. Okay, so from an advanced level, it came from, let's say there's two stock exchanges, and you have Apple stock on the Chicago exchange, and you have Apple stock on the New York exchange. Well, simultaneously, there's inefficiencies in those stocks. So traders will sometimes buy Apple here and then sell it over here at 2 cents difference at the same exact time, and arbitrage. Arbitrage means you're taking the risk out of the debt altogether.
Sure. Okay.
So if you have a good financial advisor and you go buy a primary residence, you want as much liquidity as you can get away with, because if you're paying an effective 4% on your $50,000 loan, well, then you can take your down payment, not put it down on the house, leverage it up as much as possible, and go possibly make a higher yield on that money and stay liquid.
That's right.
So when you're doing a primary residence, I'd say leverage as much as you can, because then you have emergency funds that are liquid, which is very important.
Absolutely.
You can pay off other debt that are higher interest, because almost everything is higher than a primary residence mortgage.
Right.
Now, if you're in investment real estate, it's a different picture, but that is the greatest gift we all have, is the primary resident mortgage, correct?
Absolutely. And you couldn't be more right. Think about it this way. If you have $50,000 to go put down, you can buy, let's just say, a $350,000, $400,000 asset, right? You can't buy a house with $50,000 just cash, right? You're not going to get a very nice house, right? But if you can buy a $350,000, $400,000 asset with it, that's now appreciating at 5, 6, 7% a year, right? Then you are now investing in something that's going to continue to grow using the debt, right? Not your own cash. We get a lot of people coming in and saying, I'm just going to, and especially the last 2 years, cash buyers, right? And a lot of people have extra funds. I mean, there's over $10 trillion in equity in the nation right now.
Right.
And people are wondering what to do with it.
Right.
And a lot of people come to us and say, well, I want to go buy a house cash. And I'm thinking, well, do you want to buy one house or do you want to buy 5 houses?
Correct.
Right? When are you going to make more money off of?
And that's why debt is good. Now, debt is all about responsibility. People who think debt is bad maybe don't trust themselves with the debt. So I'll give you an example. I know real estate investors that maybe they've already contracted on one house and it hasn't closed yet. And then they find another house, but they have no more funds. Sometimes they will cash out their credit cards and pay 28% interest, because that 28% interest cost is 10% of the profit that they're going to make on that house.
Right.
So everything is a whole picture situation.
That's right.
So if you're not responsible, debt is bad. If you're responsible, debt is one of the greatest tools in America, in the world, for using other people's money. Make sense?
Absolutely.
And that segues into investment real estate. I know I'm going to be launching a program shortly about buying fourplexes.
Okay.
Because here's the dirty little secret of mortgage, and I want to get your verification on this. This is some juicy stuff. Is it or is it not true that you can have up to 10 conventional Fannie or Freddie mortgages on one credit profile?
Okay.
Okay.
Absolutely.
And if you're married, you guys are smart, how much would that be for a couple?
20.
And did you guys know that conventional Fannie and Freddie mortgages consider a residential structure up to 4 units? So correct me if I'm wrong, guys. If you played the perfect mortgage game, with these guys, of course, if you played the perfect game, if each you and your spouse could have 4 units times 10, wouldn't that be 80 units you could control with just you guys?
That is correct. And we call them doors.
Doors.
Right? How many doors can you purchase, right? So a fourplex, it counts as 1 unit, but 4 doors.
That's right.
And you also reduce the risk there as well. Because if you buy 1 unit single family and obviously they move out, something happens, then you lose that. If you have a fourplex, which I love that idea, we're working with a lot of investors right now around that same strategy, then you diversifies your risk, right? And to your point, you can have more doors, more money, more income.
Yep, that's right. So I'm making it sound way easier than it is. It's extremely difficult to do that. There's a lot of stops, there's a lot of red tape, but it is possible. And what a lot of people don't realize is once you buy fourplex number 1, here's dirty little secret number 2, is all of that rent from that fourplex gets hedged off your personal debt to income in a certain period of time. So if that fourplex costs $3,000 to operate and you're making $4,000 in rent, you're going to use a factor of 75% of rent, correct?
That's right.
Correct.
That means the $3,000 debt wipes right off your credit, which means, get this, guys, somebody making $60,000 a year could play this game and roll up 80 doors because every time they buy one, it hedges off for the next one. Am I correct?
I think you're absolutely correct. And what we kind of talk about is you create your own banking system. And if you look at real estate as a bank and you do a fourplex, now you're having other people pay into your bank, into that asset that is now grown at 7 to 10%. So if you buy a fourplex at $400,000 and you rent it out for $1,200 a month, right? Then each door, that's $4,800 that you're having people pay off that mortgage, put money in your bank while your asset is growing.
Wow.
Exponential wealth.
So that's why this is the Time and Money Network, guys, because that will accelerate your path to wealth in the shortest amount of time. And these are secrets that I think you won't get in a lot of places. But be careful. We're not saying go buy a bunch of fourplexes. Talk to your financial advisor. We're not saying things are going to always go up, because things go up, they go down. What I'm saying, though, is talk to these guys about what you want to accomplish. And if it's the fourplex path, that's probably your quickest way to wealth for the average person. Would you agree?
Agree.
Okay.
Yep. Part of our counseling always is to go to a financial advisor. Is where it's the whole picture.
Counseling.
Yeah, absolutely.
You got a couch there? That
Well, yeah,
great.
we're going to get your current situation, understand your goals, and then we'll map out a plan for you.
That sounds fantastic.
Absolutely.
So anybody going to get a mortgage, if you don't check these guys out first, I don't know. I can't help you, man. I mean, these guys, they know what they're doing. We're going to get you some contact information, not how to start an application, but how to start a conversation. Again, real estate's never done without a phone call. These guys aren't hard sells. They're not going to bite your head off or anything like that. They're going to talk about what's good for you. And then what's that guy named with the bat phone? What's that guy's name?
Steve Jacobson.
Yes, Steve Jacobson.
This guy with the bat phone, if you ever get in trouble, they pick up the bat phone and some guy comes in and saves the day, which I haven't.
Will.
That's incredible.
Every time.
All right, well, that about wraps it up for today, but why don't you guys tell the audience how they can reach you and the best way to do that?
Yeah. Go ahead, Brian.
Yeah, sure. You can reach us by phone. Phone number is 877-657-1501. You can contact us through our website, www.empowerlendingteam.com, or send us an email at empowerlendingteam@fairwaymc.com.
It's never too early. Never too early to contact us.
Yeah.
And that's a good point. A lot of people are waiting, right? And we've talked about that a little bit earlier, whether it be credit, down payment. Give us a call as quickly as you can. We put a plan together. It might not be the best time to buy, but we can get you on a path to get there quickly.
Yep.
It's always the best time to buy if the asset you're buying is the right one.
There you go.
Because I think there could be a lot of foreclosures coming. A lot of builders are kind of on their knees right now.
Yep.
So you just get prepared, because this is your battle plan. Then you sit in your rental, which is, there's nothing wrong with that. Another thing I'll mention is check with your leases, but I think to get out of a lease, it's usually 60 days penalty and then 60 days notice. So imagine finding a $400,000 house with a distressed seller that could sell it to you for $300,000, and all you have to do is pay $5,000 to get out of your lease. That all can take place if you're prepared. So get a hold of these guys and let's see what we can do.
Yep.
And to that point, with the leases, we get a lot of that as well. And what we're finding is that if it's $5,000 to get out of the lease, a lot of times we can offer a price that where the seller will pay your lease.
We didn't even mention that. Yeah, a lot of the audience probably don't know that in certain mortgages, up to 3% of your fees can be contributed by the seller.
Absolutely.
That's right.
A lot of creative ways.
There's so many. You just talk to these guys, get your consultation. He'll put you on the couch. We'll do some real estate therapy,
Absolutely.
right? We'll get it done. Also, we're going to put a little special link probably on this podcast that you'll probably see flashing maybe right now or later. I don't know what these editors are going to do. But then we can see how many people are reaching out to these great guys from this podcast, which is very important for tracking. Right?
Yep.
Appreciate it. Yep,
Yep.
absolutely.
All right. Well, Kyle, Brian, this is a pleasure.
Jason.
Thank you so
Appreciate
much
you
for
having
doing
us.
this. I appreciate the little table, because that was interesting if we were going to get something done on this little
Three
table.
big guys at a little
This
table.
setup is impressive.
I appreciate the pink.
Amazing.
Next time
Yep.
I'll get the member.
We always do this. We always coordinate our colors. That's kind of what
Always?
we're known for. Always.
You're that
You're
coordinated.
setting the standard too high.
Oh man. Okay. Well, we're gonna
Count on it.
Let's end it there. I think we were on a roll. Let's go.
Yeah, right.
All right. Well, thanks so much for listening to the Time and Money Network. Again, making more money, saving more money, and getting more time back is the way you should do this. Thanks you so much. Thanks, guys.
Awesome.
We appreciate it, and we'll talk to you real soon.
Love it.